Whether you're a retiree navigating Social Security or you're an active earner, this is a video for you because I'm going to be going through the One Big Beautiful Bill Act today. Now, I can't get through everything. It's over 1,200 pages in the bill. But what I'm going to do is really focus on the things that you need to know about, especially as we enter this tax season. So what is the bill? Well, this was passed back in July, actually right over the Independence Day weekend. And there's a huge number of new credits and deductions. And the other most important piece is that the tax brackets were set to rise. This puts a pause at that and leaves the tax bracket starting at just 10%, going up to 37%. So the vast majority of Americans are going to be paying a lot less tax this year. So that's great news. Now, there are some other things to think about too. One of them is a tax break for seniors. So already seniors get an additional $2,000 deduction on top of their normal standard deduction. Well, there is a temporary additional deduction of $6,000. That is from 2025 up to 2028. It's a huge incentive. And for a single filer, essentially, it allows you to be able to shield your income up to $24,000 when you put the standard deduction, the current 2,000, as well as the 6,000 deduction. Before you get too excited, though, it does phase out for higher income individuals. For single individuals earning more than $175,000 adjusted gross income, you're going to start to see it phase out. The other big news is the SALT deduction. I know that impacts me significantly because I live here in New York City, where state and local income taxes are pretty darn high. Well, we have great news there. Used to be a deduction of $10,000. It's now gone up to $40,000, a $30,000 increase. That is a huge bump and gives a lot of breathing room to families, particularly in states like California, states like New York. But watch the fine print. The extra $30,000 in deductions starts to shrink once your income tops $500,000, and it completely will vanish once you reach an income of $600,000. All right, so now let's talk a little bit about estate and charitable planning. The Big Beautiful Bill just handed us a robust toolkit now to be able to gift to our children and leave a legacy tax-free. Each person now receives a lifetime gift of over $15 million for estate and gift taxes purposes. And there's also good news for couples. The law of portability rules is extended, meaning that if your spouse passes away not using their full $15 million, whatever that exemption is at the time, you get to go ahead and use the rest of their exemption plus yours. Now, charitable minded people like myself, if you are giving up to $1,000 as a single or $2,000 as a couple, the good news is you can deduct that without having to actually itemize your taxes. That's something new and it's great. However, those that are very charitable that like to give big numbers and also make big money, you're going to be facing some headwinds. And that is because any deductions that are below 0.5% of your income are not going to be deductible. So let me give you an example. If you're earning $1 million a year, that means that for the first 5,000 of donations, not going to count. Now, anything above that 5,000, you're going to get that deduction for. So giving to charity, definitely do it from your heart, but also be very savvy, maybe even lump some of the gifts in lower income years. All right, now there's a lot more to go through. Something I really want everyone to know about is 529 plans. The use of 529 plans has expanded. Now, in addition to college, you can use it for job-focused professional licenses, certifications, career training, and you're able to use that 529 plan to fund K through 12 benefits. Originally, it was $10,000 a year. It's actually up from that limit now. You can use it up to $20,000 a year. All right, a few last tax benefits. If you are a business owner, the 20% deduction for business owners is here to stay. So that is really important. It can really shield a lot of income. If you are an hourly worker, overtime can be deductible also up to $12,500 if you're married, up to $25,000. And if you earn tips and are in the service industry, you can also deduct up to $25,000, a really big savings. But again, I do want to tell you, watch out for some of those phase outs. The phase outs on both of those benefits start at $150,000 as well. So the next final thing for you car enthusiasts like my husband, if you buy a new car and finance it, you can deduct up to $10,000 in interest on that loan. But read the fine print. First off, the car has to be new, as well as the car has to be both a U.S. manufacturer, U.S. car company, and made here in the U.S. So this does not count for used cars. It also does not count for leases. All right, so I know that this is a lot. There's a lot of sweeping changes, a lot of things to pay attention to. But if you do, you're going to see higher tax refunds and lower taxes overall. Now, know that we are here for you. We're always looking at this very closely for each one of our clients. And if you have any questions, reach out to us. You can get us at www.francisfinancial.com, or you can email me at stacy@francisfinancial.com. We'll also give you some tools and some resources right below. Nice to see you, and happy tax season.